Hi, I'm Marc Usem, Chief Investment Officer at Affiance Financial, and I'm here today to talk about our fall market commentary. During the third quarter, markets were strong, with the U.S. market up about 20% year to date. The focus during the quarter was central bank activity. We first saw the Bank of Japan raise rates on bonds, causing the yen carry trade to unwind and creating volatility across global markets, with the U.S. markets down about 8.5% early in the month of August. Markets quickly found their footing, started back up, and later in the quarter we saw the Federal Reserve Bank cut interest rates by 0.5%. A 25 basis point cut was expected, so it was a bigger than expected rate cut. That led stocks and bonds to rally. Right after that, the Bank of China created a stimulus program that they enrolled there, causing emerging markets to really jump. And we saw emerging markets up 9.5% for the quarter, where they had lagged before. So the stimulus was really important, I think, for global markets. During the quarter, the Fed changed their focus really from looking at the economy, because the economy has been really strong. 3% in the first quarter, about 1.5% in the second, and 3% expected in the third quarter. So they can really change their focus now to inflation and unemployment. And inflation seems to be under control, 2.5%, which is really their target. And unemployment has risen from the lows of 3.5 to about 4.1, but the employment markets have been really resilient, and the most recent numbers surprised on the upside. So with the economy really looking good, with inflation and unemployment looking good, the Fed bias looking like lower rates still ahead, they have 2 more rate cuts planned. The focus for investors has been really on corporate earnings. Earnings for next year are expected to be up about 10%. Assuming no change in PE ratios, if we see a 10% increase in earnings, you could expect roughly a 10% increase in stock prices. But with lower rates potentially ahead, we could see some PE expansion, making that number even a little bigger. So with this Goldilocks economy kind of in place, things looking good for markets, what could go wrong? Well, there's always some risks, right? And so one of the risks that are out there, of course, the election coming up. Hopefully that's peaceful and goes well. Whether you like it, the result or not, though, markets tend to rally after elections. Markets don't like that uncertainty going into the election, and afterwards they tend to do well. Other risks out there include wars in Ukraine, in the Middle East, as well as terrible weather situation here in the United States with hurricanes in the southeast. So that could disrupt some GDP numbers going forward. Overall, we think the picture is pretty good, though. If you'd like to know more about our specific thoughts on the economy, GDP, or the markets, please check out our blog.